Hi, Trey's giving you a bit of an update from the trading floors as we go into the back end of Asia trade and we look ahead to the European Equity Open, where Euro Stoxx futures at the moment are down 3.3%, indicative of a tough open, and certainly whether we get the level of liquidations and forced selling and margin calls that we saw on the Asian Equity Open is obviously yet to be seen, but one suspects it's going to be a fairly prevalent feature that could exasperate some of the moves to the downside, at least on the open. We'll see what happens after that point, but things are shaping up for a fairly sinister open for European equities at the moment. Now, of course, here in Asia, we knew that we were going to get a bit of a bloodbath on open. The lead was already pretty negative, or very negative. S&P was down 6%, closing on its lows. S&P futures closed on its lows. VIX closed at 45% on the highs. S&P at the money 1 week. Implied volatility closed at 50%, one of the highest levels we've seen for a long, long time. And so we knew it was going to be very lively. And of course, the weekend news really centred on comments around Donald Trump and also Scott Bessent, where they seemed completely unnerved by what we've been seeing in market reactions. In fact, they almost welcomed it in some capacity. Now, we know that 50 individual nations have appealed to Donald Trump to try and lower their tariff rates. And in the case of Zimbabwe and Vietnam, they've actually pulled theirs down to zero to try and get their reciprocal tariff rates down to a similar level. But the market doesn't really care about these smaller EM nations. It's really about what's happening in China, Europe, the UK, Japan, India, and the big economic powerhouses, so to speak. So obviously that's what we're watching at the moment. It looks like China's going the opposite way, where they matched Donald Trump's 34% tariffs. And obviously we're seeing some big selling playing through there. And of course, we've got our eyes tonight on the EU leaders meeting, where the nations get together and they'll decide whether or not they want to lower their tariff rate and get into negotiation, or actually even go the same way of China and actually counter the move in a negative fashion for risk. So that's something we are watching, but certainly the headlines really didn't give us so much work. So we knew it was going to be an additional sell-off that came through. And of course, on the Interbank Open this morning, we're watching very closely Aussie dollar, given the moves we saw last week, and also dollar yen as well. Now, dollar yen was probably really the big nut to crack in interbank trade, and that traded heavy and then caught a leg down as we saw the S&P and NASDAQ futures opening. Now, S&P futures did open, and as we expected, it took another leg low. We saw the futures trade down to 48.32, where they did stabilise, and we've seen a big bit of a buying coming through. But certainly that caused dollar yen to trade down to 144.82. At the time we saw decent selling coming through in gold. That traded down to 29.71. Obviously, people there, not a reflection really much of the gold market. This was just the fact that people were taking profitable positions off the table to pay for margin calls and other liquidations in that situation. As we went into the equity open, we did see Japan opening very negatively. Banks under big pressure. We actually saw circuit breakers coming through in both the TOPIX and also the Nikkei futures. So they hit their limit in that situation before stabilising. And those markets are very, very heavy at the moment. We saw SPY futures opening really sharply lower as well. But we have seen a bit of risk coming back into the market. Certainly volatility has come down a little bit. We did see VIX futures trading from around 40% down to 36%. S&P 1 week implied vol took a little bit lower. Certainly people were waiting for that flush out that we saw on the equity open, whereas obviously a lot of margin calls and forced liquidation. So really no one wanted to buy risk or cover shorts until we got that liquidation out of the way. And then we did see S&P futures having a nice rally of about 3-4% to the highs of the session. NASDAQ a little bit more in that situation. And gold had a climb back up to 3,055. Certainly seeing big weakness playing through in crude, and 2-year yields are trading about 14 basis points lower at the moment. But certainly now people are starting to say to themselves, have we had more fun? Has that interbank inter-session rally taken place? And do we now re-engage with shorts as we go into the European Open? Obviously, that's something we're watching. Because if we look at the markets now, we had our chance to rally, but 1 week implied vol on S&P is now back up at 67%. VIX futures have pushed back up again. The Hang Seng at the moment is under all sorts of pressure. We're down about 10%, and volumes going through that market. I know we're playing catch up because that market was closed on Friday, but volumes are about 180% above the 30-day average. Japan's 6-7% weaker. We're talking 6 standard deviation moves on the day. The ASX is down 4% at the moment. There's not many stocks. We've got 95% of stocks are lower. And we're seeing dislocations across markets. Really probably the big one is what's happening in the rates complex, where you can see in Aussie rates, for example, that we've got a 30-odd% chance of a 50 basis point cut playing from the 20th of May. At the open, where everything was getting a bit crazy, we saw that trade up to about 90% probability. People were talking about interbank intermeeting cuts playing through. And we've got 5 rate cuts coming through by the end of the year. At least that's what's implied. Now, of course, the RBA at the same time if you read the recent statement, it suggested they weren't even looking at rate cuts at all. So, yeah, there's a big disconnect at the moment between rates pricing and the journey they're sharing and the need and urgency for central banks to come and cut rates relative to the stance that we've been hearing from Jay Powell and Governor Bullock, who does step up on Thursday to work with as well. So certainly we've had a chance to rally. We've had a bit of a move off the low post the liquidations, but now we get real again. Nothing's really changed. The market hasn't learned anything new about coming together or a pausing of tariffs. Central bankers are still pushing away from what we've been seeing, and the data flow that really needs to resonate about what's happening in tariffs, and that's going to be the April data flow, doesn't really come out until the 23rd of April when we get the PMI series playing through. So really, this market is going to stay highly volatile for a period of time. This is a day traders market. For those people who want to swim in these circles, position management, correct position sizing is absolutely paramount. You've got to be in front of the screens. You've got to understand your risk in this situation. It's not for everyone. People might want to stay out, and having no position could be a position in itself, but certainly position sizing will keep you in the game. But this is a market that's on edge at the moment. Flows are dictating situations. Volatility is very high. We'll have to see how Europe trades this at the moment. We've had our reprieve. Will now traders look to sell back into this move? I suspect that may be the case.